Okay, so good morning, everyone. Welcome to the Macro Snapshot. We are Wednesday, October the 1st, which is, of course, the first day of the month and the first day of the new quarter. It's also the first day of the US government shutdown. So, as you can see here, just looking at the Bloomberg here, you see US government data releases may be impacted by shutdown. So, the first thing to note is that the Fed, obviously meeting later this month, it's going to be doubtful at this point if we get the non-farm payrolls numbers, which is coming in on Friday, in theory, in a couple of days, which of course, in theory, that's the third of the month. So that's pretty much in doubt. So therefore, what the market needs to go on is probably, some alternative data, which obviously it always uses, but this is going to have heightened importance today. So we do have at 8:15 in about, about 45 minutes or so, we have the ADP, the private payroll number. As you can see, last time they came in at 54,000. So on the weakish side, this time they also expected to be relatively weak at 51,000. And just in terms of the employment situation overall, we know that's a big focus of the Fed. We can see here that yesterday, just interesting to see the markets a little bit sort of in risk off as apart because of the government shutdown. But you see here yesterday the conference board, the consumer confidence came in at 94.2, which was lower than expectations, 96, and certainly quite a bit lower than last time at 97.4. So the thing is here, expectations also down a little bit. So it looks like consumer confidence, at least according to this small scale survey, is diminishing somewhat. But if we look at the JOLTS numbers themselves from yesterday, they painted a relatively positive picture of the labor market in the US. You see the job openings actually was a little bit above consensus, 7.22 million versus 7.2, and certainly more than last time. And then if you look at the quits level, that's down a little bit. So you could argue that that's a little bit of a sort of a negative, just in the sense that less people are quitting voluntarily. So you look at 3.09 million versus 3.2 million last time. And that's essentially saying that people may be a little more wary about quitting their job, less confidence about getting a new job or a job with higher wages. So that you could argue that's a little bit on the soft side. And then if you look at the layoffs level, that wasn't as bad as last time and as expected. So a bit of a mixed picture from JOLTS. Nothing disastrous, nothing wonderful. And generally it does seem as though the labor situation is essentially, in some kind of balance. Not a lot of new jobs, not many new jobs are being created. But on the other hand, the companies are still a little bit wary about sort of firing a lot of people. Now, of course, with the government shutdown, this is the first one we've had since 2018. And generally what happens is a little bit of a risk off. Equities tend to tread water. Bonds tend to get a bit of a bid. Dollar maybe is going to weaken a little bit. Gold will be supported. So a little bit of a risk off tone. But what makes this time potentially a little bit different is just the fact that Trump, has, slightly more aggressive a way of dealing with things. And he's already threatening to make some of the federal workers not only sort of taking a pause, the word, to be furloughed, but actually to be permanently laid off. So he's sort of pressuring the Democrats a little bit more. And if that were to be the case, that could add to sort of the negative unemployment numbers, which of course the Fed will not like and could lead to a little bit like a definitely sort of cutting in October. So let's see what happens today. There's going to be news conferences today from the Democrats and the Republicans. A lot of, political theater, of course. But the reality is the market at this point was probably going to be fairly focused, as I say, on the ADP number. And then at a little bit later at 10 o'clock, we get the ISMs. So, of course, that's a private number, or, by the Institute of Survey of what was it? Institute of Supply Management, the ISMs. This is for manufacturing. Now, as you can see, expected for to be in contraction, so less than 50. So 48.7 last time up to 49, but still that's not a wonderful number. What's going to get probably the most attention from the market is the prices paid. As you can see, maybe a little bit less than last time, but 62.7 is the consensus. That's still very elevated and continues to feed into this narrative that the Fed is trying to juggle sticky inflation with a potentially slowing labor market. So that's going to, obviously get the market's attention. New orders always important at 50. And then employment, you see here, pretty bad number, really 44.3. expected to be a little higher than last time. The reality is that's still in contraction territory and is indicating employers who are reluctant to expand hiring. What would be perfect for equities, of course, would be the typical sort of Goldilocks scenario. Let's say, for example, we saw the prices paid come down, maybe even sub 60. The equities market would like that, with an employment situation which is, relatively stable. Maybe this number or a little bit higher. The equities market does not want to see super high prices, and it does not want to see employment either collapsing, which would indicate a weakening economy, or maybe ripping too much, which would indicate a little bit of heating. The equity market wants to see this Goldilocks scenario where price pressures are sort of moderating slowly, coming down slowly towards target, and the employment market is staying just nice and stable, not hot enough to concern the Fed, and not cold enough to indicate a serious deterioration in the economy. So that's that. Now, just in terms of, just have a quick look and see where we are for expectations. Again, for the October, that's ticked up a little bit. It's at 23.7, almost 24. So as you can see here, 95% chance of a cut in October. Market's a little more skeptical about December, although we can see from yesterday that's now up to 44 basis points, so up a little bit from yesterday, getting up towards that two cut mark, which would be 1.77. The sort of the terminal rate, so the longer term, we're looking at something. The lowest here is about 2.99. Let's call it 3%. Basically the end of next year, beginning of 2027. So essentially about 14, 15 months away. The market is expecting the Fed to cut another four to five times. I mean, to be precise about it, the market is expecting. What's the terminal rate here? We've got 4.4 times. Personally, I think that's still a little low. I think that should possibly be up to 5 or 6, or let's put it this way, could be a potential trade idea. I've mentioned that before. You have an economy which is doing, quite solidly, but still that is 15 months away. And we also never forget that next year, in May, we do have a new Fed chair who presumably will be under enormous political pressure from Trump to cut a bit more substantially than, 110 basis points between now and then. Anyway, we'll look at that a little bit later. Just in terms of other stuff, let's just have a quick look at the oil market. Actually, we've got the silver up here. So looking at some of the precious metals, silver, you can see here it had a little bit of a dip yesterday, but already sort of has pushed to sort of new highs, 47.70. Wow. Again, benefiting from a little bit of risk off. Silver, though, won't benefit as much potentially as gold. If you look at spot gold, I mean, it was interesting. I think yesterday this, had gone down a little bit, I was thinking maybe it would have some, sort of something analogous to this, like a 3 or 4 day sideways consolidation or retracement. Absolutely not. Boom, down for a few hours and already sort of pushing to the new highs here at 3,880. Again, a bit of a risk-off situation, a slightly softer US dollar. We can see that if we look at the copper, see copper here. Copper is still grinding up, grinding above the moving averages here, but not as powerfully as the precious metals. We can have a look at BTC. I'm just kind of curious to see here. Basically trading in a range, but sort of staying above its moving averages and getting a bit of a positive pop today. If we look at the dollar, that's the one which, not any crazy price action, but essentially just trading a little bit sort of heavy here. You can see here, was unable to sort of cross above the 100-day EMA and just trading heavily. So it wouldn't surprise me if the dollar fades down to 96.5 or so, especially if this shutdown continues. We continue to have political theater, no resolution in sight, no data. Because what I think the market may extrapolate is that in the absence of non-farm payrolls, that also means that the Fed will not have evidence of a very strong labor force. So as a prudential sort of issue, they may elect to cut anyway, just in the absence of any contrary data. I mean, in the absence of any strong labor market, which would prevent them from cutting. It's like, well, but again, that may depend a little bit on ADP today and, some of the ISM data we get. But all of that is to say that these are factors for the US dollar to remain a little on the weak side, which is the case at the moment. If we look at against the other, like the euro, obviously is a bit of a function of that euro grinding up a little bit higher. We had Lagarde yesterday speaking. She was, I'm not going to say dovish, but she essentially said that, the policy of the ECB was in a good place. There were still some inflation risks, but there were also risks to the downside in terms of a weakening economy, and wasn't necessarily ruling out the possibility of another cut at some point. So we're seeing that despite the US dollar, trading a little on the heavy side, it's sort of as though the euro is ripping to new highs, because because the Eurozone has its own sort of issues and just sort of trading water. So I think at the moment the market just trading water there. I want to have a quick look at oil because there are a couple of interesting comments, developments in the last sort of overnight session. You see here oil, it's got this very key level here. It's like what's that, a quintuple bottom here, down here at about 61.60 or so. So very key level on the front contract for WTI. If it breaks there, you've got to assume, at least as I was saying yesterday, down to, sort of $60 or so, or maybe even down a little bit lower. But let's not assume that's going to break because that is quite a strong support level there. But just a couple of things I was mentioning is that there were rumors yesterday that OPEC 8, the main OPEC sort of plus producers were going to add extra barrels, and that sort of caused a little bit of heaviness to the market. And then we saw overnight, actually this morning, I was just looking at the headlines of the Iraqi oil minister essentially saying that Iraq's production goal in the next year is to increase from about 4.5 to 5.5 million barrels a day. So a full million barrels a day, which equates to what's that, about 20%, 20% or so, which would be very substantial. And quite frankly, probably is beyond the capacity, just the infrastructure capacity of Iraq. But fairly aggressive comments there from the Iraqi minister, and an extra million barrels of oil per day would not be welcomed by the markets in terms of overproduction, oversupply. On the other hand, though, the OPEC ministers this morning issued a sort of a rebuttal of that news story yesterday, saying they were going to increase production. So conflicting headlines here, enough to keep oil maybe just sort of stable. We also have, actually, that's an interesting point. We have the Department of Energy numbers this morning, in theory, but again, I just wonder, and I'm going to be very honest here, I haven't actually checked. I'm not actually sure if they too will be affected. Let's just have a quick look here. So if we look at commodities and then look at energy, we can see that in theory today we have the inventory numbers, which is calling here the surveys for just almost a flat number here for the crude oil minus 150,000 barrels. But who knows if that's going to come out at 10:30, because that is the Department of Energy. So in theory, that's a government-produced number. We'll keep an eye on that. That will, obviously determine a little bit the oil market as well. Just finally, just having a look at the equities. Equities trading, relatively well. We have Nike earnings today after the bell. That could be interesting. As you say, there's nothing really to worry about from a technical perspective here. As you can see here on the chart, the ES looks, trading around highs. It hasn't breached the 20-day moving average for probably 20 days or so. Still very positive price action. We have NASDAQ also looking sort of fairly positive here. If we look at the Russell, the small caps, not as positive, trading a little bit heavier, probably in a certain sense more affected by a government shutdown. So, it seems to be sort of underperforming. If we look at the Mag 7s, still doing well. So the tech sector overall doing well. The US equities overall doing quite well. If we skip across to Europe, if we look at the Euro Stock 600 here, you can see that absolutely nothing wrong with this chart. Looks to be sort of positive, pushing a little bit higher. Although we should mention that this is coming to overhead resistance here. And basically, it has to first breach that. So we haven't quite got there, this level here, about 563. Although that's looking quite positive, but it could well be take its cue from the US equity market and just sort of settle here and have a little bit of a pullback. That would be entirely consistent with how markets often work. Okay, guys, let's leave it there. As I say, start of a new quarter. So let's see what happens with the government shutdown today, and probably more importantly, in the short term, ADP and then the ISM manufacturing numbers at 10 o'clock. Thanks very much. Have a great day. We'll continue this tomorrow.